You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I am your host, Rich Alterman, and today we will be discussing the impact of inflation and rising interest rates on consumers and lenders and so much more. I'm being joined today by Kevin Moss, based in the town of Danville, California, part of the San Francisco Bay Area. Kevin is a banking, lending, payments, and credit risk and compliance management veteran, having held key roles with Wells Fargo, with SoFi, where he was chief risk officer. He ran his own advisory firm and most recently joining the Boston Consulting Group as a senior advisor. Kevin was also a college professor teaching statistics at NYU Graduate School of Business and Montclair State College in New Jersey. Before we start, don't forget to head over to GDS Link's LinkedIn and Twitter pages at GDS Link and hit those like and follow buttons. And be sure to subscribe to the Lending Link on Apple Podcasts, Spotify, or wherever you prefer to listen to your podcast. All right, now let's get synced with GDS Link. Good morning, Kevin, and welcome.
Thanks, Rich. I appreciate you having me on the show today.
Well, I definitely want to thank you for joining the Lending Link today and being my very first guest. I'm very excited to be chatting with you. So where are you joining us from today?
The East Bay, Danville, California, our home here, usually also in San Francisco during the week, but today we're out at our home.
Great. Well, appreciate that. So before we get talking about business, let's get a bit personal. I know you were born in Long Island and went to undergrad at George Washington University and right after that, New York University to get your master's. How did you end up in California and what was the big change for you after growing up in New York?
At the time, I've been through I think 6 mergers and acquisitions in the banking industry. And one of them, I was on the East Coast living in Delaware. And I had met the chief risk officer of Bank of New York, which was one of the firms I work for, who introduced me to the chief credit officer of Wells Fargo. And I reached out and ended up getting an interview and a role out here and moved out here in 1998. So Bay Area has been home for almost 25 years now. And it's where I think my kids feel is home. It's where they really grew up. And this is where my family is. So at this point, it feels like I've been here forever. And while I do miss a lot of the food in New York, the pizza, the bagels, I really enjoy what the Bay Area has to offer.
So let me ask you a question. When you're not working, what are some of the things you like to do that brings joy to your life?
Well, I'm a big basketball fan. We're Warrior season ticket holders for a number of years now. And I'm so excited that we're seeing pregame. The season starts on the 18th. So basketball is one of my favorite things. And then, we have a big family. We have 6 kids and 4 grandchildren with a 5th on the way. So
congrats.
Pretty much every weekend involves doing things with our family. Like this weekend, we had a baby shower that we sponsored on our side of the family. So between a big family, working, going to basketball games, I like to follow the financial markets. There's not a lot of time left to do some other things. I used to play golf many years ago, but for the most part, I do like working out, but that's about it. I mean, there's not a lot of time left, unfortunately, for other things.
Well, thanks for sharing. It's always good to get to know people a little more on a personal basis. So let's dive in about business side of things. Like you and me, we've been in this space for a very, very long time. I think together we have about 80 years of experience in the industry. So as you think about it, what would you say have been some of the biggest changes that you have seen in our industry during the time that you've been involved?
Yeah, I mean, when I started, I think it was 1984, there were 5 credit bureaus. There were a lot of private bureau and local offices. We've seen all that consolidate into the 3 major credit bureaus. Credit scoring was very simple. We used to have what you call the step 1 score, where it was expensive to get a credit report. So if you couldn't pass the score based on your application information, you would be declined exclusively. Today, it's mostly based on the credit bureau. And I think probably the biggest thing that I see is just the advancement in data and analytics. Many of the algorithms, regression based algorithms, were prevalent back then because they were easier to calculate. But today we can do amazing things with machine learning and decision trees and all kinds of ML and AI type applications. So I think the data that's available and the algorithms that are available today to build models and strategies are much, and the internet was not really out there. I mean, I remember getting my first personal computer back in the late 80s on floppy disks.
I can remember my first computer at Citicorp was a TRS-80 visit from Radio Shack, I believe. Yeah, one of the things I talked about on the first podcast, and you kind of mentioned it, Kevin, here is, the sheer number of data bureaus that are available today. I mean, when I joined GDS, if we had shown our connector list, it had Equifax, Experian, TransUnion, Dun& Bradstreet, and that was it. Today, when we talk about it, there's 100 that we work with in the US and probably about another 100 globally. But certainly one of the big areas we've been seeing on the data side is around permissioned data, where consumers or businesses have to permission themselves in. And, we think about on the open banking side, we have companies like Plaid. I understand that you recently joined there on the advisory board.
Correct.
Yodlee, Direct ID, and congrats for that. On the employment side, we have Argyle and Pinwheel are some of the companies out there now. And then on the on business side, we think about companies like Kodat and Validus. One of the things I was thinking about as we see more and more of a movement to let consumers control ownership over their data, thought about the main bureaus, Equifax, Experian, TransUnion, and maybe even LexisNexis and Innovis. Could you envision a day where those main bureaus may also move towards a platform where consumers do permission themselves, similar to what we see with the Plaids and Yodleys and Argyles of the world?
Well, I think some of that infrastructure is already in place. I mean, first off, technically, you gotta, if someone's going to pull your credit, you have to give them permission by opting in to that. But if you wanted to, you could freeze your credit report. And the only way to get to it would be to allow it to be unfrozen. But only a very small percentage of people actually use it today. And I think the reason is because Americans have gotten used to, like, if you walk into a retail store and they offer you 10% off by purchasing it on credit, people like the speed and availability of credit. But I think, and frankly, when I think about like the financial data exchange, right now, on average, 50% of the people, when you request their online banking credentials, opt out because they don't want to share their personal credentials. Financial data exchange is trying to create a framework where that data gets tokenized, where you get like a one-time passcode through a common structure that everybody will exchange data with. And so even that could move away from credentials, but certainly you'd have to, as the owner of that data, once 1033 comes to pass, consumers are going to own their financial transaction data. I think those two things together will likely drive, I think, an easier process than it is today, and maybe a more trusted process.
So maybe you could elaborate a little more on the financial data exchange. Who are some of the drivers behind that initiative?
All the big banks are members, all the aggregation companies, Plaid, Finicity, MX, all of those are involved in this. It's going to take some time, but I think once 1033 passes, the need to have a consistent framework and tokenization of the permission, I think, is going to be essential to enabling a lot higher than 50% access to this.
So, as our primary topic today, I wanted to chat about the impacts that inflation and rising interest rates are having and will continue to have on the lending industry and, of course, consumers. There's no doubt that the current economic conditions are impacting consumers' ability to manage their financial affairs and make ends meet. In August, the Lending Club Corporation, the parent company of the Lending Club Bank, released findings from the 12th edition of the Reality Check Paycheck to Paycheck research series conducted in partnership with Payments.com. Kevin, I'd like to share some very concerning findings from that report. In June 2022, 61% of Americans were living paycheck to paycheck, up from a low of 52% in April 2021 and 55% in June of 2021. The average savings dropped $517 from 11,724 in May of 2022 to 10,757 in June of 2022. The biggest rise in paycheck to paycheck consumers was in consumers earning between $100,000 and $150,000, up 11 points from May 2022 to 52% in June of 2022. Pretty astounding. An estimated 33.5 million or 13% of US consumers spent more than they earned in the past 6 months. That's incredible. And of course, in addition to the rise in the cost of daily living expenses, the Fed has sharply increased the cost of capital, making it more expensive for non-bank fintech lenders to put capital on the street. With these two forces at work, let me open it up to you to share your industry observations and perhaps your predictions for the next 24 months. And most importantly, what recommendations you have for lenders to successfully weather the current storm.
Well, first off, fintech grew up in a interest rate, low inflation environment. And right now, with what's going on in the world between the effects of COVID, the war in Ukraine, and the supply chain challenges, higher inflation has driven the Fed to raise rates pretty dramatically over the last few months. And so this is one of the first times that fintech has actually worked in a higher inflation, higher interest rate environment. And in my view, this is an area where being a bank is a big advantage because banks have a thing called deposits, and banks, when rates rise, net interest margins of banks widen because deposit rates rise much more slowly.
Right.
So fintechs fund themselves with warehouse facilities, securitization markets. They originate to sell, and credit spreads have widened at the same time. So this is probably the most difficult environment that I certainly have been in since I've been involved with fintech for the last 7.5 years. And it may be the most difficult environment. Certainly, we had a tough March and April in 2020 when COVID hit, but this is going to be a prolonged environment where we're going to have inflation. There's components of inflation that are sticky that aren't going to be driven by interest rates, like the cost of energy, supply chain issues with chips. Like those things aren't going to resolve themselves simply because rates are higher, right? The idea of softening demand. So in my view, what we're going to see in this environment is we're seeing new venture capital funds being much lower. New lenders are not getting funded unless they have really good ideas, good leadership teams. And I feel that in my consulting business, because that was who I principally worked with for the last couple of years, were early stage lenders. I think higher interest rates and inflation are squeezing the lower income borrower below 60 to 70,000 to make and reprioritize their payment hierarchies because food is so expensive, like basic staples of living, filling up your gas tank. And so what we've seen is the impact of this is that the 21 vintages, particularly second half of 21, for personal loans, credit cards, are not good. They're the worst that they've been in a number of years. Subprime auto has been deteriorating as well. And they have inflated car values, particularly used cars, because of the shortage of supply of new cars and chips. I think in the broadening of the credit impact beyond just non-prime is we're going to see credit normalize by the end of this year or early next into pre-pandemic levels. So we're going to likely have some type of recessionary period heading into 2023, which is normally in a mild recession, you'll see about a 30% deterioration in credit performance, and the average recession lasts just under a year. So I think 2023 is going to be pretty tough. The other things that have happened in this environment are like all the deferments and forbearances that occurred, which were the right thing to do for the customer due to the COVID problem we have, impacted score to odd relationships where credit scores, the traditional FICO Vantage that everybody knows, in my opinion, were inflated because the payment history was deferred. And then there's been a proliferation of credit builder trades. And some of those product structures are good, like getting more people to report rent and utility payments makes all the sense in the world. Those are real payments that people are making. But some of the product structures, in my opinion, that some of the neobanks have put together are brilliant for them in the sense that it allows them to earn higher interchange through credit products rather than debit transactions. But the data that's being reported is almost all positive because there's almost no credit risk in the way that the products are structured because they make the payments for the customer.
Right, right.
And so all of that is biasing scores along with the deferments. And part of the problem that has led to some deterioration in credit performance is that scores were inflated and it gave people a false sense of the credit quality that was really being originated. And last thing I'd say is, and I think people have pulled back and we're seeing tightening now, the portfolio delinquency levels were so low for so many businesses, and coming out of the expectation that COVID would cause this deep, deep recession, and all the great work I think that was done by the government with enhanced unemployment and stimulus payments and the like, all the programs that came out of the Small Business Administration to help small businesses, that really helped. And so some lenders, I think, got a false sense of comfort, and probably in like the first and second quarter of last year, started to loosen credit.
Right.
And I think that contributed, along with all the other things we've talked about, with why the 21 and early 22 vintages may have been worse than people expected.
So talking about the issue with the credit scores and deferments and changes in some new products like buy now, pay later and credit builder products. We talked earlier about the use of banking data, open banking data. The pedal card company just spun off a new division called Prism, where it's really focused on the use of open banking data. I think I read where they said they could approve, or the pedal card approved 35% more consumers by using open banking data, which is certainly helpful as a CFPB looks to the lenders for more financial inclusion. Any advice or thoughts you would share with the audience? You recently joined the board of Plaid, and the robustness that open banking data can actually bring, especially in conjunction with a traditional credit report.
Yeah, so I'm an advisor with Pedal as well, and I've been working with deposit data for 20 years myself, even as a banker. So the proliferation of open banking and getting on average about a year's of transaction data when you do aggregate through your deposit account or other accounts, I believe it's extremely powerful. And recently wrote an article with Alex Johnson of FinTechs. And the basic message from that was the buy now, pay later trades, the credit builder trades, income share agreements for student lending. Like these are all, in my view, fintech product innovations that the bureaus are not currently structured to support. They're basically forcing them into the traditional R or installment or revolving type of product structures when they're new product structures.
Right.
The pay in four is not like any other product we've had in buy now, pay later. The credit builder trades, they deserve to have their own trade line because right now some of the trade lines I discussed earlier are being treated the same way in these models as an American Express trade line would be. So to me, the credit bureaus have to innovate their credit reporting to provide more granular data and trade line types. And that's not a simple thing. The thing about the aggregation data it is granular. And so for those who Pedal, I'm a big fan of the Prism product, what Pedal's done is it's really a two-step process where we take this raw transaction data and then create attributes or features from that could summarize income, the stability of the income, the cash flow, and other aspects of what we're seeing in somebody's checking account. And then models can be built based on the product experiences and outcomes that we have, just like with normal credit scores or other targeting algorithms. We can use those features in models to estimate the probability of default or the probability of being fraud or overdrafted. And so my view is that 97% of the people supposedly have a checking account. And as we know, there's 40 to 50 million people in America that don't have credit reports. Or if they do, because of the separation of non-prime credit reports as a separate clarity or factor trust structure that the credit bureaus own, they don't get credit for being in the main credit file. I think aggregation data has a huge potential to get many more people mainstreamed into the credit system.
Right.
And I've seen standalone models that are as powerful as the models that we can build with credit bureau scores. And it's more up to date because literally, if I aggregate someone's deposit account today, I see everything that happens to that point, to this day, whereas credit reports are lagged 30 to 60 days.
Yeah, so I'd be remiss if I didn't put a plug in for GDS. We do offer that capability to take in the bank data, and we're agnostic to whether it's Plaid or any of its competitors, and generate categorization and help build models. So certainly something we do as well. I want to come back to something you mentioned about some of the challenges in collections and rising delinquencies. And we work with a lot of personal loan, installment loan companies, as do you, from an advisory perspective. And when I think about a consumer who's sitting there each month and struggling more and more to make ends meet, and they're having to make some tough decisions about which bill to pay this month. And we think about a personal loan, installment loan, that really, once I get that loan, the utility that that product brings to me is really not there. If I think about comparing that to a credit card or an auto loan, where I can continue to drive my car, I can continue to take that credit card out and pay for products and purchases. So how does a lender that's offering a personal loan product, what are some suggestions you might give on how they can more successfully help prioritize the payment of their product when that consumer is having to make a decision about whether they pay their credit card, auto loan, versus having to pay that personal loan?
Well, I mean, first off, if you're a bank or if you're a company like SoFi or a lending club, hopefully you have multiple relationships with them. So first thing is consumers if you have a good relationship with a consumer, they're going to prioritize your payment. So a lot of it has to do with how you treat people. And so I think companies that have multiple relationships in a deteriorating environment will have an advantage over single product companies for sure. Yeah. And I think the way you're going to have to work with that is you're going to have to segment your customer base from the people who are most in need of assistance to the ones who are very comfortable and can self-cure on their own. And you're going to have to work with consumers on providing relief where they need it. And one of the areas that I feel very strongly that FinTechs have not fully leveraged is the opportunity that consumer credit counseling, non-for-profit consumer credit counseling services offer. I'm close with the NFCC, which is their national organization. I've worked on some projects with them. And what most people don't know, the way to think about this, the lesson I learned, I ran the home equity business at Wells Fargo for 4 years during the last financial crisis. And the one thing I saw was that even if I charged zero interest, I could not modify my payment low enough to put people into the position of affordability. The only product that can do that is the mortgage product, typically. So the power of consumer credit counseling services is that they can do almost like a customer level payment modification, where if they have a bunch of credit cards, what happens with personal loans? How do people run into trouble? A lot of times people run up their credit card debt even after an attempt to consolidate it and pay it down. Because about 70% of the people, the use case for a personal loan is debt consolidation. And so consumer credit counseling has what they call debt management plans, and they're experimenting with some longer terms even, but today they're limited to typically 5 years or less. And when they get a consumer into one, they lower the payments 5 to 600 bucks. And there's two benefits that come out of this. One is, hey, if I can get my borrower a lower payment on all of their other credit or most of their other credit obligations, that's going to free up cash flow for me.
Right.
The other thing that they do is they take a look at a consumer's expenses. A lot of people need that kind of, because they schools don't provide basic financial counseling or how you run your financial life, and a lot of people run into trouble because they don't know how to budget, they don't know how to manage expenses. And
Mhm.
so I think those are the two things that a consumer credit counseling a non-for-profit agency can do. And it's totally under leveraged, particularly by the fintech world. A lot of companies don't support them and use them. And I think that's a huge mistake.
Well, that's some great advice for the listeners today, and certainly encouraging to see that several states now are actually passing laws that require financial literacy as a requirement for graduating from high school. So we're kind of getting close to the end of our time today. I'm going to throw out one question to you for the audience, and then we'll call it a wrap. And maybe I could have you back again. I think you and I could probably talk for about 4 hours. So I do a lot of career guidance, talking to friends, children of friends of mine, and what industries to look at. Especially, I always tell my friends if their kids like math, that we always say that data is the new oil, and if they can really latch on to that, because certainly analytics is ubiquitous, really across any industry. Every single industry uses analytics. So let me ask you a question: if you were talking to a rising college individual, or someone getting close to looking at graduation from college in maybe 12 months, what are some of the things that you would tell them to get them excited about the industry that you and I have devoted our lives to?
So first off, the first thing, I mean, we put 6 kids through college. So I have a lot of experience in being a former college professor. Like the first thing I tell people who are going to college is it's an investment. You have to think about what you study as preparing you to go out in the world to be somebody, to be
Right.
something. And like there are certain, if you have the skills and capabilities, there are certain degrees and majors that have much higher employability and much higher income potential than others. And particularly the STEM majors are, when people are coming out with those degrees, they're likely more employable at higher incomes.
Yeah.
And so I would tell people, think about your college education just like you would think about an investment for the future. People who are just starting out, where you should be the biggest risk taker at the biggest risk taking part of your career. I think working in startups, and I love financial services. It's been virtually my whole career, and analytics and lending and credit risk, very actuarial and very rewarding because you're helping people achieve goals of their life, whether it's buying a home, buying their first car. Like, it's exciting. And so I would stress to people, study the right things in school, make it a valuable experience for you coming out of there, and then search for companies that have missions that align with your values and work with products that are important for consumers as well, and businesses, where financing is something that's important to growing the economy. And if your company is, in the way that they're doing it, in the way that they deliver it, is aligned with your own personal values, then that's the kind of career you want to try to pursue.
Well, great. Well, appreciate that. Everybody, we've been talking with Kevin Moss, industry leader in financial services, talking to us today from California. We look forward to maybe some future podcasts with Kevin. We wish him congratulations on his new role with Boston Consulting Group, joining the advisory board at Plaid. And I know he has a long list of other companies that he brings his experience and expertise to. So thanks, Kevin, and I hope you have a great rest of the week.
Thanks, Richard. Again, thanks for having me on the show today.
Take care.